Hi, and welcome to another edition of the Trustcast Show. And I'm really happy to have with me today Caleb Brus. Did I pronounce the last name correctly,
That's
Caleb?
perfect. Thank you.
Okay, good. So Caleb spent years as a chief compliance officer for a Fortune 500 financial giant, answering directly to SEC and FINRA before walking away to work with small veterinary clinics and Wall Street, which is kind of a unique story. So, tell me what made you trade in your corner office for corporate finance for representing local vets in the unique niche that you occupy within a company that also occupies a unique niche.
Yeah, first, thank you for having me here, Zane, and I appreciate it. It's a question I actually get quite often. When you consider what most professionals do in a legal perspective, they oftentimes start in private practice and they move in house. So I had the opportunity to go directly into house right after law school. And part of that story is I had a strong mentor even before I entered law school, and a lot of coaching about what I should do, what I should practice, and the first company that I should work for. So as you noted, I started in house, worked within the employee benefits perspective, primarily within the decade that I was there. And it was through that same mentor over time, working with her about what's going to progress my career, what I'm good at, what I'm interested in. After a period of time when she had retired, she had all along the way had said, "I think you would be a good fit in private practice based on the way I approach my work, the way I interact with clients." And when she had left the company, we stayed in contact and we still do. And she'd indicated the firm that I'm at was a really reputable firm, good culture, good reputation with clients. And it was through that conversation I agreed to have a coffee actually with our managing partner at the time. And through discussions, we talked about the firm, talked about my experience. And one of the things that really drew me in is how quickly they moved. I went from a coffee, let's call it a Thursday, to an interview on Monday, to an offer on a Tuesday. And I was really attracted to the pace of moving into that. But more importantly, one of the things that I lacked and desired while working in house was direct access to our clients. So when you work in house anywhere, the company really is your primary client. There's secondary beneficiaries, and that's plan sponsors, the companies that we serve. And so I was really motivated to go into private practice to have that direct client interaction. Again, a very reputable firm, and then specifically within the vet space. So my father's a veterinarian, so it was a natural place that I was interested in. And one of the things I discovered through some market research is I believe there still is a lack of representation across the market, whether that's the Midwest or nationally. And so I began to develop the expertise. I sort of grew up in the space with my father's a veterinarian, but discovered the overlap with the benefits, helping companies and clinics stay privately owned, not go to private equity, and find different structures that can help them maximize the culture, the experience with employees, and the impact on the community.
So let's talk about your firm,
Mhm.
the firm you work for, BrownWinick, specializes in a very specific area of the law, and that's ESOP. Just explain to people, because to me was really interesting, just ESOP in general, and then more specifically the niche that you're in
Mhm.
within that. So maybe you can talk about ESOP in general and how Wall Street gets involved in that or gets shut out in
Mhm.
many ways when that happens.
Yeah, I love talking about this topic. And so an ESOP stands for an employee stock ownership plan. It is a type of retirement plan, and it's similar in some ways to a 401k with individual accounts. What's fundamentally different about most ESOPs is that participants in those plans do not actually defer money in. It is all employer contributions. Oftentimes, it's worked in conjunction with a 401k. But what I really love about it, in addition to a retirement plan, it is an exit vehicle for owners and a strategy for keeping those clinics privately owned and out of private equity. It's essentially a sales transaction. So when you think about an M&A type of deal, the ESOP transaction is very similar. Rather than a buyer and a seller, you have the company, which technically is the seller, and then you have the trustee of the ESOP, which is the buyer of the stock. And so what I just mentioned is it's a nice blend where you create this really tremendous and beneficial retirement plan for the existing owners, the employees of those companies, but at the same time, it provides liquidity for those current owners because they will actually sell the stock to the ESOP, and that funds the stock that gets ultimately allocated to employees of the company. So again, this is an opportunity that I'm seeing in the market. Oftentimes when vet companies come to me, they're not even aware of an ESOP. They're thinking about selling. They don't want to go to private equity, or I'm working with clinics to form a new company. They've worked with a private equity owned company. They did not like how the cultural changed, and we're end up setting up new entities. So with that, I'm layering in the proactive strategy of considering these ESOPs in the marketplace.
So I want to talk about. I want to dig into this because I think this topic is really it's interesting to me, and that always makes for a better show when it's interesting to me because I'm
That's
digging for
great.
the questions I want answered. So let's say I have a clinic and I'm getting towards retirement age, and I'm thinking, "Oh, I'm going to sell this. I don't know what I can get out of it, but I'd like to get the most I can." But I'm also I've had Betty, who's been my veterinary assistant. I have a couple other vets who work out of here, and I hate to leave them in the lurch, but I got to protect myself and my family.
Hmm.
I'm sure that this is the thing that's running through most people's mind. So the first thing they look at, uh, how can I get the most amount for
Hmm.
when I sell my clinic? And then, but I also have these personal relationships with my employees.
Hmm.
They're usually, small businesses.
Hmm.
Sometimes they're medium-sized businesses, but um, they feel like if they just sell it to whomever, their employees are probably going to get jacked around.
Yes, so that's a very astute point about the purchase price, and that is a very common consideration when we think about an ESOP or selling to a strategic partner or to private equity. If you're looking at just those two variables, side by side, traditionally speaking, private equity or a strategic buyer will oftentimes pay more for the clinic or the company. However, that is just one variable that goes into discussion. One of the things we often talk about in this context is culture is extremely important. It really needs to be in the mindset of those existing owners what is most valuable to them, the legacy of their business, the impact to employees and the community. And again, if you look at the side by side comparison, in most cases, the purchase price for private equity or strategic buyer will be higher, but it doesn't consider these other opportunities, whether for the existing owner or the employees. For example, the owners will sell at a price. They will have their shares purchased by the ESOP. However, they also get to continue if they want to work for the clinic, to be a participant in that retirement plan. So they're also structuring a retirement option for them in addition to the liquidity and the cash flow they would receive from the transaction.
So, talk about the tax implications. What are the tax implications of just an outright sale versus an ESOP?
Yeah, that's great. That's really motivating for many clinics and companies to move into an ESOP. Once an ESOP is formed, the company will stop paying taxable income, because it's going to be exempt because it's held by the trust. There's different structures by which the owner can move into an ESOP. There's something called a 1042 election that can help with taxable income for those owners as well. However, the sort of the catch and why this isn't oftentimes moved into, one, it depends on the type of corporation, whether it's a C corp or an S corp, and also importantly, if they take that 1042 election, they are barred from participating in that retirement plan. So there's a variety of different considerations, but again, the taxation is huge, because again, the company stops paying income on its profit. And then when you think about, it's a qualified plan, so think of a 401k. It's not tax avoidance, but it is tax deferral. So those funds and accounts that grow over time, for that vet assistant that you mentioned. And by the way, one of the favorite stories we always hear is that vet assistant or that front desk person has $1 million or $3 million in his or her account, didn't contribute a penny, and is tax deferred until they start to draw funds for retirement.
So, that's always a great story, but then selfishly,
Mhm.
as an owner, um, I'm just going to talk about the financial side. So you said the outright sale to whatever a Wall Street vulture, whatever you want to call them. I shouldn't say that. A lot of the guys on Wall Street are great
Exactly.
people. um, to a Wall Street firm is probably going to net the largest um, income, like directly. Here's your sale. Here's the amount of money that we're going to
Mhm.
give you. But then there's the rest of the backstory. I would imagine when you do weigh everything out, the tax implications and all the rest of that, um, how do those calculations go? So yeah, okay, I get more money if I
Mhm.
just sell it outright, but then I have all these other benefits. But really, um, will it always end up being more money, or sometimes with the tax implications, it's actually you can end up netting in a better position than you would if you just sold it outright?
Yeah, it's a very good question, and the short answer is it depends on the structure, depends on the amount of the ESOP formation. But again, I think it gets into the question of long-term play or short-term play. So if you look at it a vacuum, like I said, the short-term play is going to be private equity, Wall Street, etc. But over time, depending on the structure, the participation in the plan, oftentimes it nets out or is a longer benefit, and it oftentimes depends on the age of the existing owners, how long they'll stick around, whether they'll participate in the plan. So these are great questions because these are the types of conversations you have to have on the front end. Because again, when you get that purchase offer from private equity, the purchase offer from the ESOP, they're almost always going to be lower on the ESOP side. So we have to have these conversations to fill in the gaps with the knowledge about the tax impact, the participation, the culture, all the things that I'm repeating. But these are extremely important. What motivate a company to consider. And one of the aspects that are an important early stage that our firm does not do is a feasibility study. It goes in, looks at the demographics of the business, the taxation of the business, the makeup of employees, and ultimately that's a determination whether the ESOP is a good fit. And from there, that's when the discussions with the advisors, the attorneys, the consultants come into play. It's a great question, but it's a difficult one to answer because it really depends. But I think you're right in alluding to the right point. When you look longer down the road, ultimately the benefits are reattained through those benefits I just mentioned.
So let's say I'm going to pose hypotheticals because I think that's a better way to do that. And we'll talk about maybe some individual stories too that you have. But let's say I am a veterinary clinic owner, medium size. I don't know what medium size is, but pretty busy. And I imagine you're in Iowa, right?
Correct.
Yeah, and so you have large animal vets, and they can be pretty significant businesses in and of themselves. But let's say I'm an ongoing concern, but I'm like 15 years away from actually, thinking about retiring. How does the ESOP play into that scenario?
So 15 years from retirement, that's where when we talk about the tax impact and like the 1042 election that I mentioned, we'd likely want to structure the ESOP such that the existing owner, the person who's 15 years from retirement, is going to be able to participate in that plan. The other factor that we haven't talked about yet is the structure of the financing that deal. Oftentimes, there's going to be a loan from a bank to help fund the repurchase of the existing owners, or there can actually be seller notes. So in addition to that person who's 15 years out, who's going to be able to participate, start saving for retirement, they can have continued liquidity through seller notes or a blend between seller notes and bank financing. And oftentimes they will take a lesser rate of return because of that, because they're able to um, mitigate the need for full financing from a bank. So there's a variety of different factors, including their liquidity either upfront, their seller notes, their participation in the plan. But again, if you're 15 years out, that's a decent window where it would be important and beneficial to those owners to structure the deal such that they can actually participate in that plan.
So, what I didn't understand was when the idea of not paying taxes. So,
Mhm.
how does that work?
It's because the trust is exempt. So the contributions made to the ESOP either can be through cash or stock. Again, oftentimes ESOPs are going to be leveraged is the term we use in the industry. That just means it's funded by a loan. So those contributions are made, and those profits are essentially, because the stock is owned by the ESOP, the profits exempt from those taxes, so they no longer have to pay taxes. It's extremely beneficial. It seems like a loophole in some respects. Maybe you can say that it is, but it was really designed in this way to maximize and incentivize those tax savings. And one of the reasons why we have so much regulation in this space is because of this. For example, one of the abuses that Congress wanted to prevent is the abuse of just doing this for the benefit of those owners. So if you've heard of a term called non-discrimination testing, that is a really important topic for all retirement plans, including ESOP. And there is going to be some checks and balances such that they want to make sure um, the non-highly compensated employees or those non-owners are benefiting to a high degree or a sufficient degree that it doesn't appear as if this is just a tax play for that owner. Does that answer
So
your question?
it did, but it brings up a couple other questions. So I'm thinking, if I'm selling my company, and in essence, my company then becomes a non-taxable entity. My employees, obviously, and their income is taxable,
Hmm.
but over the corporation, or I don't know if it's still called a corporation, the corporation, I'll just call it that, um, doesn't actually, it's a trust and doesn't actually get taxed. It's just the employees that get taxed. Is that right?
Correct. Yeah. So assuming it would be 100% owned ESOP, so the ESOP is going to own the entirety of the company. That ESOP is going to be exempt from tax, and you were correct. There's going to be, of course, taxation from employees through either W-2 income if they're employees. If they're owners, it's going to be K-1 income. And then ultimately, once they start to take distributions from their retirement plan, they will have, of course, taxation just like any retirement plan would provide for.
So what about I'm asking financial questions, but this is probably what your ideal customer or client, potential client asks. What about retained earnings? So that at the end of the year we have a banner year and we have a bunch of retained earnings. We're not gonna give that out as income either to the owner or
Mhm.
what would be primary trustee, to the primary trustee or any of the other trustees in the plan. We're going to retain that. How is that treated from a tax standpoint?
Yeah, there's different structures. Sometimes those earnings will be used for dividends that can be allocated to participant accounts. Oftentimes, those allocations of S distributions, for example, would be allocated in the exact same way as the contributions would or the shares. The most common way is compensation. So if I have $100,000 in compensation, you have $200,000 in compensation. You will receive twice as much. The other factor that I'm not the expert on, or the other consideration, is we're seeing companies who are ESOP owned companies, and they're going back to my comment about culture, is they have this excess pool of cash and they're not sure what to do with it. Maybe they're limited based on the deduction standards within a 401k and an ESOP. They're looking at actually investing in other funds, investment funds. And some of those investment funds, similar to private equity, are actually investing in companies that can be or potentially would be a good fit for an ESOP. And what they're doing, instead of just turning over those companies like private equity would, they're eventually converting those companies into ESOPs. So it is a way for them to invest some of that excess earnings either into other potential ESOPs, or it's through the S distributions and dividends within the ESOP itself.
That's interesting. I hope everybody's keeping up. Yeah, I thought that's very interesting. So let's say, can I even sell part of my clinic to someone who isn't a licensed vet using the ESOP? So I'm the vet, but in essence, I'm no longer the owner.
Yeah, so it's a great question. In almost every state, including Iowa, there's going to be restrictions on ownership. So, for example, in Iowa, you'd have to be a licensed veterinarian to own any part of the clinic. Well, to give credit to Wall Street, like we're talking about, they found a way, whether it's through an ESOP or through an equity incentive plan. There is a structure called an MSO, a management service organization, which enters into an MSA, a management service agreement, with the clinic. And what it does, it provides services on behalf of the clinic, such that revenue goes from the care providing portion over to the MSO and ultimately down, and it can go to non-licensed individuals. So we're talking about ESOPs, but we can even use a simple example. We have the front desk worker. He or she is not a licensed veterinarian. we want to give that person equity into the company. Well, you need to set up the MSO, set up the MSA, and that front desk person can actually receive shares of stock despite the fact that they're not licensed because they're having ownership in the MSO, which think of that as like a sister entity to the care providing clinic. And again, to give credit to private equity and Wall Street, they found a very clever way to work around many of the state restrictions about ownership.
So if I get a call from a corporate buyer from my practice out of nowhere, is that a good sign or should I be worried? What does that mean?
It's neither a good sign or a bad sign. It's a good sign in the context of, clearly there's a market and there's interest in the business. Um, it could be a bad sign in the context of whether that's the right fit for the owner. To me, it's cause for bringing in professionals, whether that is an advisor group. Oftentimes, those are the right people to start with. Included within some of those advisor groups, they may be a firm that engages in the feasibility study. But to me, that causes the question of what do I want to do? What is important to me? And who are the right professionals to start speaking with? So really, to me, it sort of festers up and raised to the surface of the question of what should I do next? And what I can tell you is, I go to a lot of, vet conferences and I talk to a lot of veterinarians. It's sad but true. Oftentimes I'm speaking to an 80-plus-year-old veterinarian. He does not or she does not know what to do with the business. I've ran into a situation where they can't find a buyer. They end up wanting to wind down. So to me, it's a blended example of let's raise the question, start figuring out. Ideally, it's not before that person is 80 years old, but it's while they're 15 years from retirement so they can actually have a proactive point of view.
So yeah, I could see the 80-year-old vet who's just working all his life and he saved up whatever money, but now he's facing retirement. And actually it's a pretty severe drop in his, but then he can't sell it's the same thing happens to plumbers and since your firm really spans the gamut, it happens in many industries, I'm sure. So what is driving all the private equity to veterinary medicine right now? So people don't think
Mhm.
about veterinary medicine and Wall Street in the same sentence usually.
It's a good question. I think private equity is expanding in general. Typically, there's pretty good margins, whether it's in the health space from a human perspective or the vet space. It's a somewhat relatively new market for private equity. So there's a lot of opportunity there. The other part of it is the lack of knowledge on options, like I mentioned at the beginning of this conversation. Oftentimes, I'll use my father as an example. My father's an amazing veterinarian, but I don't think he would consider himself to be a strong business professional. So it's an opportunity where private equity can come in, offer a premium. They likely don't have a strong plan in place. And not only does it look like a great option, it looks like the option. Um, the other part that is, in my point of view, and again, I'm not anti-private equity. Oftentimes I think there's better options, self-serving a little bit in that statement. But when you talk your earlier question about ownership, it is inherently a little bit problematic when non-licensed individuals at a private equity owned firm start to come in and make decisions. Again, there's some restrictions in place and there's some safeguards in place. But when you think about those non-licensed owners, it can be problematic from a public policy standpoint about what decisions are they driving down, right? So I can tell from personal experience when I walk into a vet clinic and I can tell within 15 minutes whether they're private equity owned because the approach they take to clients, how they talk about billing, where the conversations occur, I can quickly tell what are they being driven by. And again, I put no fault on those veterinarians and vet techs. At the end of the day, they become employees and they're not owners. But it's a delicate blend between that non-licensed ownership and who's actually making medical decisions.
So I know exactly what you're talking about. You can see that in various industries when they're corporate owned. Actually, a large car dealer in town, I saw an immediate change. They went to owned by AutoNation from a local family, and just every part of the dealership became measured by how much profit that it generated. So is that what you're referring to?
Absolutely. There was a recent example. One of my dogs had surgery, had a spill in the yard, had to go into a specialty clinic. Part of that was it was on a Saturday. It was after hours, and because it was a specialized surgery, we had to go back to the particular company or clinic that did it. And my experience was I'm sitting in a lobby, I'm waiting to get checked in. The vet techs are coming out talking to the owners, and all they're talking about is here's how much we think it'll cost. By the way, it'll be an extra $150 to shave a quarter size hole on your dog so we can put an IV in. And I was in there at a time where a family was actually there. And based on context, excuse me, I could tell the dog was hit by a car. And the conversation went along the lines of, well, here's what's going to have to happen. It's going to cost this and that. And I could hear the family, of course they're troubled by the fact their animal was hit, but they were indicating to the staff, I don't think we can afford it. And what I'll tell you is those conversations, in my opinion, should be private. They should be in a private room. I should not hear what they're going to do with their dog. I should not hear if their finances are sufficient to pay for it. And to me, when I hear revenue costs come up first and not what is wrong with your animal, that's a strong indication to me that the structure is, in my opinion, out of sync and likely because of the construct of the ownership we're talking about.
So when you have so when a big buyer rolls up a bunch of clinics into one company, what usually happens with the original doctors after a couple of years?
Can give you a couple of specific examples. They either stay and tolerate it or they go off on their own. For example, I'm working with an individual. His daughter is actually the veterinarian, and he's going to essentially fund the new clinic. So we're actually creating the MSO structure, like I talked about. But she was there for a small period of time, less than 2 years, determined that it wasn't the right fit. She felt the culture had been ruined. She no longer liked to work there, didn't feel empowered to make her own medical decisions. So we were actually setting up new clinics. So, one clinic is bought, other clinics pop up because oftentimes these doctors, these veterinarians don't want to stick around. So we're just seeing smaller clinics pop up around.
So could you conceivably, if you were a growth-minded veterinarian, use your ESOP to roll up other veterinary clinics into your ESOP?
Potentially, one of the concepts within retirement plans in general, but including ESOPs, is participating employers. However, typically those need to be within what we call the same control group, or essentially the same ownership structure. So you certainly could have multiple clinics participating in one ESOP. If they're unrelated, it's a different construct that may not be a good fit. But it goes back to the example where I'm not the expert on this, but these private funds that are investing in companies that are not currently ESOPs, but they intend to be ESOPs in 3 to 5 years. So that would be an investment opportunity. And again, depends on the structure, whether it's related entities or non-related entities within that ESOP.
So let's try some rapid fire just for a little break here,
Okay.
because then I have some other things. So favorite Iowa State fair food?
I'm pretty boring. Corn dog. Corn dog.
Okay.
If you've ever been to the state fair, there's everything's on a stick. Everything is deep fried. And I'll give you the one example. There's a lot of things I wouldn't really want to try based on a health decision. But the one that is popular, but I would never try, is deep fried butter. It is literally a stick of butter, deep fried in batter of some type, and you are just eating it, a whole stick of butter. And I don't know what that does to someone's cholesterol, but I can't imagine it's good.
So one word for your negotiating style.
It's a great question. Creative, I would say. Creative.
One thing still on your bucket list.
I want to climb Mount Kilimanjaro.
Oh, wow. So you must have watched that show, Seven Peaks.
No, I haven't actually. I'm familiar with it, but I've
Oh, you
not
need to
watched it.
watch it. It's fantastic. Legal term you wish everyone understood.
Hmm.
That one's
Well,
kind of
this is sort
obscure.
of tongue in cheek, but plan document. I ask for plan documents all the time. No one seems to know what that actually is. It's a generic name, but plan document.
So what is it?
And so the plan document is it's the formal document that sets the terms and conditions of an ESOP or a 401k. There's it's a very generic name, which I get why that's difficult. Oftentimes I'll ask for the plan document, I'll get the summary plan description, I'll get the adoption agreement, I'll get a plan summary, but it is the 70 to 100-page document that has the pure formal language that talks about the structure and the plan design of the ESOP or the 401k.
So walk me through what actually happens step by step the day a company decides to become an ESOP.
So first it would begin with the feasibility study. There's some sort of interest or there's been some advice about whether that they should move forward. They go through their feasibility study. Let's assume based on the results, they're a good fit. Going to engage an advisor firm. That advisor firm is going to start to bring in other professionals such as the attorney, the CPA, evaluation firm, etc. It's a big party, and ESOP transactions require a lot of support. They're highly technical. From there, once a decision's been made, we need to figure out the structure of the company, whether it's an S Corp, a C Corp, or if it needs to be converted to one. My first step typically when we get into the plan drafting stage is what I call a plan design call. So think of a menu from a restaurant. There's many different options that can go into a plan. And we start to discuss, do you want a 6-year vesting schedule? Do you want a 3-year vesting schedule? Should employees be age 18 or 21 to be able to enter into the plan? Do we want to have immediate entry, or is there a service requirement of 1 year, for example? So we start the discussion about what does a plan look like, and then we start the discussion between the actual transaction side. So that is going to be, again, the company who's going to be selling the shares, the existing owners, and then the trustee. The trustee is going to start a negotiation with the company about what it's willing to pay. One thing we always warn our clients about is you're going to be insulted initially by that trustee. And the reason for that is this, because these are regulated plans. The Department of Labor wants to make sure that there's an arm's length transaction. And under the code, the ESOP cannot pay more than fair market value for the shares. So there is a real back and forth. And again, because it feels like a friendly transaction, you're selling to an ESOP. Oftentimes those existing owners feel like you're going to get the purchase price that they want on the first try. That's not the case, and it's really important that you see that back and forth from the Department of Labor's perspective. Once that's been set in, there's term sheet, there's purchase agreements, there's the plan document, there's a summary plan description, there's a trust agreement. It looks very much just like you're selling to a strategic buyer, except for there's unique provisions for the ESOP itself, the plan I talked about. And then there's going to be documents related to if the plan is leveraged and a loan, either through seller notes, bank financing, or a combination of the two. It will take, it really depends how quickly a client moves, about a month at least to complete the transaction. From there, once the ESOP is formed, the trust agreements are completed, we will actually file what's called a determination letter with the IRS. That is going to be a file that includes the plan document, the trust agreement, and various other ancillaries. And the IRS will actually review the entire plan and those documents and determine whether it's in compliance with the law. That is a retroactive decision. So despite the fact that we might wait a year or two, the IRS is not very quick in terms of how fast they move. The plan can be operated, and ultimately the IRS may have some changes they want to make. We might retroactively amend to address that, but ultimately the ESOP is now in motion. That clearly is a very quick summary of how it works, but structurally is the key points.
So how do I figure out even what my practice is worth for a deal like this?
That would be the valuation experts. And sometimes a lot of these service providers in the space actually have blended models. Some will be a valuation expert, some will do the feasibility study, but they won't do both of those in a transaction because of the conflict of interest. But it would be through that valuation and then the negotiations between the company and the trust, what the company is actually worth.
So is an ESOP realistic for like a 5-person clinic, or is there a certain size only for bigger practices? Or
So 5, no. Everything's fact and circumstances, but if I'm answering based on that, 5 is too small. There has to be certain factors that indicate that the ESOP would be a good fit. For example, in my opinion, you'll see studies lower than this, but my personal view is 30 to 40 employees is going to be sufficient. Part of that's the non-discrimination testing rules that I talked about. You want to see at least $1 million in revenue on an annual basis because there's going to be contribution requirements to the ESOP, particularly if it's leveraged. And the culture I talked about, the 5 is most likely too small.
Okay. So you've written about ERISA fiduciary duties and cybersecurity. What's the real way a data breach turns into a lawsuit against plan trustees?
Lack of process. So that is the most important issue that I emphasize to my clients, the fiduciary board. So ERISA standards from a fiduciary perspective are known as the highest standard in American law. So they are to be taken very seriously, but at the same time, process is going to be more important than outcome. So I'll give you an example. Let's say a clinic has a cybersecurity breach through no fault of their own, but they have a well-documented process for mitigating, preventing, and remediating. In almost all cases, they're going to be better off than if a different clinic who did not have a cybersecurity breach went through an audit and they discovered they lacked any process. So better lucky than good does not apply in this context. The quickest way that you're going to get into trouble is lack of process. The other important point when you think about retirement plans, as you likely know, there's a large degree of support on record keepers, TPAs, and the amount of data that those TPAs and record keepers have is just tremendous. And so what I oftentimes remind our clients about is, just because you've outsourced that function to a TPA or record keeper, they are just an extension of your fiduciary liability. So upfront, you have to go through a prudent process to select that service provider. Have they had cybersecurity breaches? Have they been in the news? Do they have SOC 1 reports, SOC 2 reports? And then that is the point in time prudence standards under fiduciary duties. And then there's the ongoing monitoring, right? So most of these big record keepers, TPAs, have, particularly in this space, a SOC 2 that looks for cybersecurity and privacy breaches. You need to look at that report on an annual basis. You should be checking in. So again, if you made a great decision on the front end to go with ABC company, but ABC company did not provide sufficient services and protection over time, you've likely failed your ERISA fiduciary duty of prudence and monitoring.
So tell me about one of the most satisfying um, ESOP results that you've had, in your career now.
Yeah, I appreciate that question. It's been about, a year and a half ago. It was a relatively newly formed ESOP company, and the company asked me to come speak to their employees because, there was questions, there was interest. And even though it's been 2 years, these ESOPs are complicated. It takes people time to understand. What I really enjoyed about it is I walked into that room, all their employees were sitting there, ready and engaged. And on a big banner was the the share price over the last 3 years, and it was just skyrocketing. And what was even more satisfying to me is the level of engagement. This was typically ESOPs outside of vet practices are manufacturing type of companies, and you saw a manufacturing type of person. They're sitting in there in their clothes that got grease all over them. They're asking about provisions. They're asking about retirement, and they're so excited to be owners of the company. I'll say this as a joke. Often, one of the bigger things that we have to help clients manage is, Sally or Joe, who's now an owner of the company, thinks they get to make decisions about where people park. Well, they don't run the company; they have equity in the company. But it really paints the picture, in my point of view, how excited and proud people are to say, "I'm an owner of this company." And if you run these ESOPs the right way and you get the right professionals involved, anytime you tie incentive to performance, that's a good thing. So these ESOP owned companies typically have lower cost, higher revenue, they generate more ideas, they have happy culture. And the most recent stat I reviewed is those employees who have an ESOP on average have twice the account balance of those that do not. So it is a tremendous benefit, and just makes people proud for the company they work for.
So as a completely outside view on this, if I was working for a firm and owned an equity share in the firm, I think it would incite my creative juices and my willingness to work beyond the hours that I might normally. And so in some ways that creates a lot of value in the company. So if you were to sell your company to the ESOP in essence,
Mhm.
and you had 15 years to go, that could actually net you a much higher um, uh, payday in the long run. I mean, potentially,
Mhm.
it just occurs to me that that could occur.
I mean, absolutely. I think I mentioned, we're always so happy to hear the story about Sally or Joe working the front desk and they have $3 million in his or her account. It's just amazing. And then when you think about that in the context of they didn't contribute a penny. I mean, that's truly amazing to me. And then I completely agree with you. And as you mentioned at the beginning of this, I worked for a big corporate machine, a very good company. And one of the things I learned when I was in leadership is those who have the best ideas, believe it or not, it's not a surprise, are those who are on the front line doing the work. And so if you don't have a structure or incentive in place, even if that person has the best idea, you know, in a corporate environment, even if they share it, which oftentimes they don't, it has to go through such bureaucracy to get to a decision point, to plan for the next 3 months, to make a decision, to maybe not implement. That is not the case when you have this direct incentive with these owners, to maximize profitability, to come up with new ideas. Being proud and having that culture is hard to measure, but it's tremendous, and that's why these ESOP companies are becoming more and more popular, and that's why they stick around for ESOPs for, a very long period of time.
Caleb, thanks for coming on. It was a really interesting topic. I really appreciate it.
Yeah, thank you so much. Thanks for having me. I really enjoyed it as well.
So hang with me for